Welcome. I'm Michael Landsberg, Chief Investment Officer of Landsberg Bennett Private Wealth Management, and welcome to our second quarter market update. I'm going to talk a little bit about the first quarter and again what we see going forward the second quarter and for the rest of the year. Let's first take a step back and let's talk about PEP, patience, emotions, and process. This is a time that investors need to have a lot of patience. A lot of stuff's going on, there's a lot of noise out there, and in reality, we need to kind of be patient with this process and let it play out. Investors have a tendency during times like this to get emotional. And emotions are exactly the wrong place to be when investing your money. You can have emotions with a lot of things. Seeing your wife, seeing your husband, seeing your grandkids, those are all great emotions. With the stock market, with money, emotions usually leave you out in the street or broke. We don't want any of those things to happen. So let's check our emotions at the door and lose our feelings. Part of that and how we do that is we have a process, a defined process that is risk management, and it's math-based. Doesn't matter if something happens on the TV, if the numbers don't match up, we don't do it. And the key is to have a process, is the process has to be rules-based, strict, and emotionless. And that's actually some of the processes that we'll talk about and why we've been able to navigate this environment so well. Part of that was, and that process had us reduce our exposure to technology stocks back in January. Part of that was it had a good couple years in terms of the run, but also our model showed that we're going to see a deceleration in sales growth and earnings growth for some of these bigger companies in the tech sector. Doesn't mean that they're going to be going down in terms of their earnings, meaning they're going to be losing money, but when the growth is 200%, then 100%, it's hard to keep growing at those numbers. So we're seeing those numbers start to come down a bit. And what happens is a lot of those valuations, because the stocks have done so well, are kind of priced at those up 100, 200% earnings numbers, and they're just not going to be there. They'll still be up double digits, in fact, quite well, but we think the market had overpriced that. That was the reason we took our exposure down back in January to technology stocks. And in particular, a lot of the Mag 7 stocks, we took those down even more. The other thing that we looked at was we realized inflation was going to start to decelerate. That was an uncommon opinion back in January because if you remember, we were very bullish on inflation going higher in the fourth quarter of last year. It's one of the reasons we bought commodity exposure last year was we thought inflation would accelerate and we thought commodity prices would go with it. Back in the first quarter, we realized we're going to start to see a stall in inflation, and it caused us to sell a lot of our commodity exposure, and instead we bought gold. Gold and platinum and silver. But the idea was we're expecting a little bit of a deceleration in inflation. That's a good thing. But at the same point, what we looked at it, there's places that benefit from deflation or disinflation than inflation. So we wanted to make that pivot. What's important to realize is a lot of the noise that's going on right now with stocks are about tariffs. And in fact, the tariffs have sucked the air out of the room. That's all we talk about. But in reality, the economy's not bad. Again, we talked about inflation. Inflation just reported a much lower than expected CPI number. It was actually even lower than we had, and we are at probably one of the lowest estimates that we had seen. That's a good thing. Inflation is coming down. The other thing that's very positive is job losses. A lot of talk about DOGE and going and cutting all these costs, but in reality, the private sector and jobs across the country haven't really come down that much. That's actually a positive. So the trick as an investor is to keep kind of two conflicting opinions in mind. The facts are the economy's not in bad shape. We think earnings are going to grow this quarter, but not as much as they have in the past. Inflation's coming down and jobs are pretty good. The other side is tariffs and the unknown. And what's happened is the market is reacting, or in my opinion, overreacting to what's going on with tariffs. The market's going down, there's a couple tweets that go up, the market goes up. The 10 biggest market increases since 1950 have all been in bear markets, when the market is trending lower. We don't think this is any different. That's one of the reasons we positioned for a bear market back in January and again in February when we bought some shorts to basically insulate us from going down as much. And that's a key consideration. Again, you can have a decent economy and still have the stock market go down. Again, they're not directly correlated. And so the key is to kind of take that apart and say, okay, we think the economy's not in bad shape. We think inflation's going to come down. We think that's going to be a good thing for maybe the back half of the year. But in the short term, we're expecting this volatility to increase. And what we've seen has been exactly that. The president, in his trade negotiations with tariffs, it's on, it's off, it's on, it's off, has kind of whipsawed the market. and it pushed volatility to levels that we haven't seen in about 10 years in terms of volatility. Typically, when we see that, we have a tendency to want to pull back. Meaning, as from investors, the goal was we'd done that before. We did that in February prior to some of this. And for the most part, our understanding was the president had broadcast that April 2nd was going to be Liberation Day. For anybody not to have positioned themselves for a big market event April 2nd, I kind of wonder what they're doing. We bought shorts, we raised cash, we trimmed some of the positions that we thought were more likely to be affected by tariffs. And that's one of the reasons we had a very good run here compared to the markets based on the fact that we had prepared. It was not about just making a guess. It was about kind of reading the room and looking at what was going on. The data that was out there was saying, hey, he's going to push tariffs. And the scenario was we were also seeing a deceleration in earnings growth. And when you had those two combined, it made sense for us to pull some money off the table and be more defensive. Again, that doesn't mean that we think that we're going to be in this environment forever. But the idea is there's times to be on offense and times to be on defense. And even though the economy right now is saying, hey, things are not bad, we look at the market, and again, this tariff uncertainty is to say, you know what, it makes sense for us to be on more defense. And at the end of the day, defense does win championships. We did see that with the NCAA basketball tournament, that it wasn't a high-scoring game, but the good defense, especially on that last shot, was the difference between Florida winning and losing. Defense does win championships. And in portfolio management, not losing money or not losing a lot of money ultimately gets clients to where they need to be. One of the best examples of that historically, Warren Buffett's never really had a top-performing Berkshire Hathaway. It's never really been the best. But it's also never really ever been the worst. And what he does is he wins by not losing. Or certainly when he loses, they're not outrageous losses. And that's been our motto here, is we want to make sure that we participate on the upside, but we want to give downside protection. We want to make sure that things aren't going really, really down. Because if you lose a lot of money, you got to make a lot more money to get back to even. And that's really why we started again to pivot, added more gold to the exposure. We've got US Treasuries in the portfolio as well. That's giving us some stability. And again, we've used these inverses, these shorts that bet against the market for us to basically take down our expectations and our exposure to stocks. Again, we don't think it's going to last forever, but until this uncertainty with tariffs goes by, we think we're going to see that. We also think there's a good chance the escalation here becomes more of a US versus China scenario. For a lot of this tariff talk, it was the US against the world. And it kind of propelled some European stocks. We saw some trading blocks. But recently, this pivot from the president, primarily because I think interest rates were starting to move higher, I think they got around and said, listen, our big problem here is with China. Let's kind of make some deals, or at least start to get back to the negotiating table with the rest of the world, and let's take China on a little bit one-on-one. And I think the scenario is you do run the risk of having a Chinese-United States trade war. But again, China's 13%. We import 13% of our imports from China. It's not 100%, it's not 90%. And we are the largest customer of China. It would behoove China to actually negotiate. The difference, I think, that for us as Americans to try to understand, and it's a comment that the Treasury Secretary made, is they've got a losing hand. The problem I have with that analogy is the United States is a capitalist country and the Chinese are communists. We might be playing poker, they might be playing blackjack. I just don't think that the scenario is they don't have the ultimate outcomes or the desires that we do. The Chinese government controls, or suppresses dissent. The CEOs have vanished for months at a time when they were outspoken against the current government in China. So I don't think it's really an easy comparison to say we've got the better hand. I think we've got a good hand for what we want to do. The problem is I'm not sure if they're going to be playing our game or not. So we think that could drag out a little bit. We don't have exposure really to China across any of our portfolios. Most of our businesses, obviously, it's U.S. stocks or U.S. centric. And again, because the Chinese don't buy a lot of U.S. product, it's not something that they're going to be giving our companies a lot of money. The areas it becomes more difficult is for the companies that manufacture things in China. And I think you're going to see the president and his team look to try to get people out of China manufacturing. And I think we should have learned our lesson during COVID. When remember, we couldn't make anything here. We had all of our PPE, not to be confused with PPP, but all the equipment that we needed to protect ourselves. We couldn't get anything. We couldn't get test tubes. We couldn't get masks. They're all made in China. You'd hope that at that time, whether they come back to the United States, I think is probably a pipe dream, but we should have diversified our manufacturing to other locations that aren't necessarily antagonistic to us. This president may push United States companies basically with some exemptions to say, hey, we won't slap tariffs on you if you decide to start relocating, whether it's Vietnam or South America, wherever it would be, I think you're going to see a push there. So I think this China scenario may play out for a little while. The good news, it looks like we're getting on board with the rest of the world as not being an antagonistic relationship. Part of the reason they're pushing the tariffs is to fund a tax cut. And the question really is, they've got a tax cut that's set to expire. I think there's votes certainly to extend that. But what I've seen kind of the rumblings on, they want to make a bigger tax cut. Politics aside, not sure that's the greatest idea. We're $36 trillion in debt. I'm not sure if adding more debt to that is necessarily a great scenario. But at the same time, I look at it from a market participant standpoint. Yeah, if taxes went down, that's probably good for corporations. It's probably good for earnings. It's probably good for those of you watching that own stocks. So that part of it, I think, is a positive. The question really starts to become is how do they actually get this money to be able to kind of pay for the tax cuts? Yeah, positioning, again, we think the back half of the year is going to be better, but we think there's going to be a lot of chop between now and the summer until we get some resolutions around the tariff scenario. I think that's going to hang over this market a bit. The other thing that we're looking at is there's going to be some selling pressure on some of the Mag 7 stocks because the big indices are going to lower their weightings basically in June. So you're going to see some of the stocks, not all of those Mag 7, but there's going to be could potentially be some selling pressure because the indices kind of did what we've been saying for the last couple of years. They realized that there's too much money in too few stocks. The other day, for example, 30% of the move was 3 stocks. That's probably too much concentration. And I think the indices have realized that, so they're going to be capping the amount of money in stocks based on kind of market caps. That again, currently that number is lower than where they are now, so that means there'd be some selling pressure on some of those names. Again, we saw this kind of writing on the wall in January. We reduced our exposure to a lot of those names, so we don't think we're going to be hit with anything from that standpoint. But the idea the market overall may see some selling pressure based on the fact that some of those most widely held names, they're going to have a lower reduction in the indices. And again, the indices would be the indexes, but also most managers institutionally look at themselves versus an index. So if the index has XYZ of 9%, the manager is going to have somewhere near 9%. Well, if the index is going to go to 7%, that manager is also going to be somewhere around 7%. The managers don't have to be exactly the same, but a lot of times they benchmark each other based on that. At least institutionally, in the pension world, that benchmarking is very important. So we think there's going to be a pressure. One of the advantages that we have is we don't benchmark ourselves to that. We're in the business of managing money for you, not competing against some index. So the goal for us is not to lose money when things are going badly. And that's basically been illustrated in the last 60 days. When the market's fallen apart, our strategy has not. In fact, actually, we've started to actually kind of pull away in terms of performance, primarily because we just haven't lost as much on the downside. That's always been a hallmark of our firm, is I don't worry about making money on the upside. That seems to take care of itself over time. And I may miss some of those upsides. As we did in part of 2023, we were so worried and did such a good job in 2022 of not getting hurt that we let that defensive posture stay a little bit longer in a 23 than it needed to be. But again, I would take that versus having things go the other way and having accounts and portfolios blow up, which you're seeing a lot of the market right now. A lot of these investors are getting huge losses in this market, 20, 30, 40%. Our strategies are down 2, 3%. That's the idea when you have a downturn, is not lose the money. Again, we can make the money to come back. So that's kind of the key. We want to have some patience. And again, this is going to take a little bit longer to play out than we want. You as an investor need to remove emotions. We have removed emotions entirely from our process. On a good day, you can't tell by my reaction if the market's up 1,000 or down 1,000. That's the way it should be. We're just executing based on what is in front of us and what's happening. And again, it's math-based. If we have stocks that are doing well, we continue to own them. If we have stocks that start to fall apart, earnings aren't good, we get rid of them. The idea is small losses don't hurt investors, large losses do. And that part of that's being, kind of being stubborn. And it gets back to not having a process. Again, we have a process for buying and selling and for risk management. At the end of the day, again, avoiding the losses or the big losses is the key to an investor being able to, retire well, keep retiring, enjoy the lifestyle they have, is not having those drawdowns, not having those 2008s and those 2022s that were significant drawdowns. Yet if you lose a little bit of money, you can come back. If you lose 10%, you need to make 11% to get back. but you start losing 25 and 33% of your money. You need to make 33 and 50% to get back to where you were. So the law of large numbers works in the opposite. You want to make sure you don't have the big losses. And we've done a very good job of that. We continue to do that. We've got more cash than we have historically had, and part of it's because we just don't know what's going to happen with the tariffs. And unfortunately, right now, the market's trading on tariffs rather than fundamentals. And when that happens, it typically is a time to not fight the market, is to say, you know what, we're going to hunker down a bit, keep our cash high, keep our shorts, keep our gold, and say, you know what, let's kind of let the noise pass down. We will get back to fundamentals. We will get back to when earnings getting reported are the important thing. And again, we're positioned for that. We think earnings, again, are going to be up 6 to 8% for the S&P 500 for the quarter, and double digits for NASDAQ, about 12 to 14%. Again, down from the first quarter, but still up year over year. Again, they're still accelerating year over year, but from the quarter, they're going to be down, and that makes sense. The impact of tariffs will be on different sectors. Some sectors, for example, not going to have much impact from tariffs, and some will. And our job has been to navigate which ones have exposure to tariffs or high tariffs, and we've lowered our stock exposure there, and which ones don't have any of the tariff issues, or a lot of them. We want to overweight those until we get some clarity. Thank you for being a client, joining us on this ride, if you will. We think it's a little bit choppy to continue, but again, underlying fundamentals aren't bad here at all. Unemployment, the job figures have been good. Inflation's coming down. We think earnings growth is going to be positive. We don't see a recession anytime soon. You might start hearing that word. We just don't see it. But again, right now the room is being sucked dry with tariff talk, and we think that's going to be the overlying environment. That's why you're not seeing us run to put some of this cash we've got on the sidelines back in stocks. We're not trying to buy the dips here because of where we are, this volatility, and again, this noise around tariffs. There's just no reason. It's kind of like flying blind. I don't necessarily want to fly when it's super foggy, or drive when it's super foggy. I'm going to sit on the side of the road till the fog goes away a bit here. Again, we've hunkered down. We think we're in a good position. We've had good performance. When you look at kind of the market overall, we're down very fractionally, and that's important. So again, we appreciate the trust you show in our team. And again, if you have any questions, please feel free to reach out to us. Again, thank you for your time.